from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde in New York, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, tech stocks, their worst week since the pandemic shut America down in March 2020. Could this be a humbling correction for the sector? We discuss. Plus, we'll talk with Bitfury CEO Brad Brooks about the big crypto sell-off we're witnessing and Bitcoin hitting its lowest level since July. This on the heels of a House hearing that took place on Thursday. We'll have all the details. And with all the volatility in the markets, we'll take a look at which brands have the best staying power. Thanks in large part to their messaging campaigns, we'll dive into the best companies in power and grow. First, though, we've got to dive into these markets. What a finish. What a volatile week. It was a short week. It felt like a very long one. Tech stocks dropping this Friday. Investors focusing on the worrying signals as earnings season gets underway, but also what the Federal Reserve will do next week. Ed Ludlow, you got the breakdown.
I mean, that's that bearish pivot that we got halfway through the week. That's what's so astonishing. So much red on the screen, right? The takeaway, the NASDAQ 100, very tech-heavy index, having its worst week since March 2020. My goodness, do I remember March 2020. Every market participant does, of course. NYSE FANG Plus Index following with the same pattern. Tech stocks broadly feeling that pain. And semiconductors, the Philadelphia Semiconductor Index, or SOX, down for a fifth consecutive day. But of course, it was such an outperformer in 2021. And then you get to the end of the long short week. You get there. And then Bitcoin comes at you at 5 p.m. Eastern time on a Friday, because in the last hour, Bitcoin has fallen from $38,100 to $36,000. Did they get the memo late on this risk off, Caroline, or are they just...
Same thing happened yesterday, right?
What is happening? They're trying to keep us on our toes, but bring up the next board, Mr. Director, because I do want to focus on the equity markets and the NASDAQ 100 and that bearish tilt I was talking about. You're right, Caroline. It seems like at the beginning of the week, we came back from the long weekend holiday and we were looking at the outlook for rates, the Fed. We were focused on yields. But then later in the week, yields actually receded a little bit, but the NASDAQ 100 continued lower. We had that news from Peloton, of course. We had a lot of news around Netflix, and then we focus on earnings and look at the decline and how that carried on across Thursday and Friday. I do want to look at those two stocks specifically very quickly. Peloton actually kind of rebounding on Friday. Of course, the CEO and the company came out late Thursday night and outlined their plan to get back on track. Cut production volumes because of weaker demand, shrink the company, make painful layoffs, and investors responded positively. But Netflix, the biggest drop since July of 2012, down more than 20%. We know the story. An outlook of 2.5 million subscribers for the first quarter, far softer than the street or even Netflix was expecting. Why? Changing macro environment, economic pain in emerging markets, and competition. What a week.
The perfect marriage of macro and micro. Ed, you always do it for us. We thank you so much. Let's stick with exactly where Ed was leaving off, the biggest weekly drop for tech since the start of the pandemic. To discuss what's changed, if anything, Mona Mahajan's with us, senior investment strategist at Edward Jones, who joins us now from Warren, New Jersey. It's always great to have your market analysis, Mona. What do you make of the drops?
Yeah, look, it's been a brutal week for investors, and not only tech investors, but investors broadly. We now have an S&P 500 down 7%. NASDAQ is down 12% year to date. Keep in mind, that's 3 weeks of 2022 already. What we think about is we really do try to take a step back and think where we are in the macro picture. And what we see is really we're still in what we're calling mid to late mid part of this economic expansion. So certainly you guys had referenced 2020. This is not an economic year like 2020 was. We're still looking at GDP growth plus 4%. We're still looking at earnings growth 7 to 9% in the S&P 500 this year. We're still looking at a consumer that remains pretty healthy. Corporate balance sheets remain pretty healthy. We are not by any stretch, and certainly by any forecast we've seen, heading into any sort of recessionary environment. So we would not expect the markets to head towards recession-like bear market 20% plus drawdowns. Now, the NASDAQ has broken some important technical levels. Could there be more pain ahead? Absolutely. But what we're thinking about, particularly for the first half of this year, where could investors win? We do think value and cyclical investments hold up well. We do think non-U.S., international and EM in particular, they could win also by being more value heavy, less tech heavy. But I will also say for those investors that are longer term, that don't have the tech exposure that they want, we do see that story coming back into favor, especially as growth does slow, perhaps by end of this year through next year. And so don't give up all hope yet. We do think, volatility is likely. We are hopeful that the Fed steps in and maybe puts a little bit of hope underneath this market. But in the meantime, make sure your portfolio looks balanced, has some of those value cyclical and non-U.S. exposure as well.
So, Mona, do you think the Fed will back off because of the gyrations in the market?
It's interesting. I think some of the market has done some of the work for the Fed. We certainly have had rates move from 150 to 180 levels in the 10-year. We've had markets now price in 4, in some cases 5 rate hikes for 2022. We certainly see an end to the balance sheet tapering. Of course, markets starting to price in QT now, so balance sheet contraction by mid this year as well. So when the Fed does meet next week, we don't expect them now, or the probability of them having a hawkish surprise for markets is much lower. So could they, in fact, then come out with a slightly more dovish message than the market expects? Perhaps the probabilities are tilting in that direction. And so, right now the markets are in a bit of a void. They are waiting to see what's on the mind of Jerome Powell and the Fed, certainly waiting to see how the rest of earnings season plays out. Both of those could be a source of stability in the weeks ahead.
Mona, many like to say this is a healthy correction. Many don't say it's a healthy bear market. But I am interested in whether you think this is actually, a lot of that brought forward valuation, front-running a lot of the growth that we were yet to see in some of these stocks, is actually just coming out of the market somewhat. Should we find a sort of level? Is this in some way where some tech stocks should be trading?
Yeah, it's a great point. And, look, we have said, and we've looked at the historical analysis does show that as the Fed starts its tightening cycle, valuations do compress. And we do see the highest value, more speculative parts of the market underperform. And so when you look at tech thus far, the NASDAQ, as we talked about, down 12%. But if you look at more speculative plays, ARK funds, for example, down 24%. Bitcoin, as you guys alluded to earlier, now down also 20% plus. So we're certainly seeing within that tech spectrum, those higher valuation speculative parts of the market underperform. That we think does make sense. And we continue to see, rate volatility, especially as we get through this Fed hiking cycle, that could continue to have or spark bouts of volatility in those higher valuation speculative tech markets. Now, from an S&P 500 perspective, down 7%. And we've said this in the past, in any given year, historically, 1 to 3 corrections in the 5 to 10, maybe 15% range are the norm. Last year and the year before, we actually haven't gotten many. We had 1 5% correction last year. And so perhaps we're starting the year with a bang, but perhaps the volatility is returning, in fact, to more normal levels. And perhaps offering some opportunities, especially if you think about these pullbacks as opportunities to diversify portfolios or add to risk if you haven't done so already. If we don't see that 20% plus drawdown, it may take a little bit of time for stabilization, but we certainly see opportunities in the market ahead.
Next week's going to be a big one, the Fed and earnings. Mona Mahajan, it's always great to check in with you. Thank you for your expert analysis there. Meanwhile, stay well, have a great weekend, and we continue to look at a story that we're looking in terms of lawmakers going to rein in big tech potentially with antitrust bills. Google ramped up its spending in Washington last year while it fought off antitrust scrutiny. According to disclosure reports, now the company spent $9.6 million on lobbying in 2021. That was a more than 27% increase from the previous year. Still to come, we'll talk more about tech stocks seeing massive sell-offs in an interview with the CEO of Silicon Valley Bank. We'll see what he has to say in terms of the public markets and the private markets. Gregory Becker's with us. This is Bloomberg. Quick look again at how tech stocks performed today. It wasn't pleasant if you're along these markets. Red on red on red. Let's talk about what that all means in the context actually of investing in technology for the year. Can you make a trend out of this for 2022? Greg Becker is with us. He's the CEO of Silicon Valley Bank. On because you've just had your own numbers. You are, of course, a company that, what is it, about roughly 50% of the venture capital companies out there in the US, many VC firms, bank with you. You had a record year. Is that likely to continue?
Yeah, well, it's great to be here. Interesting week to be on Bloomberg, but we'll hopefully provide some
kudos for sticking with us. We thank you.
Yeah, no problem. Some calmness to it, because I think it's important to think, at least the market that we're in, to think about this not on a daily basis, weekly basis, but to think about it longer term. So I'll describe that. But we had a great year last year. Last year was a record year in almost every category. We had almost 70% asset growth. Our net interest income was up incredible, and we had a great fourth quarter. And what was also positive is that we increased our guidance for 2022. And that's before there's any benefit of rates. So that's the good news. Clearly, the challenge is what you're seeing, we're all seeing right now, which is the tech correction that we're watching kind of on a daily basis.
From your perspective, did you see it coming? Did you feel that this is sort of where valuations had gone too far too fast? There needed to be some sort of realignment, or is this taking you by surprise?
Yeah, I've been at SVB for 28 years, and I've seen a lot of different cycles. And what it always feels like there's the public markets tend to, I would say, overshoot the mark periodically, and then they undershoot the mark periodically. And it feels like that's where we were last year. Everything was priced to perfection. Everything was going well. Nothing could go wrong. And that's just not the world that we live in, especially with high growth companies. The fundamentals are still very, very, very strong with these companies. Clearly, some are being impacted negatively with the pandemic and supply chain, or with the pandemic hopefully being behind us in the not too distant future, some of the pandemic stocks correcting. But if you really look at the fundamentals of so many businesses, it's really just the valuation is coming down a little bit. And we also see that almost in every situation when rates start to pick up, you start to see the highest growth stocks tend to pull back. So I don't think we should be that surprised we're sitting here right now.
Talk to us about what the private markets are telling us right now, because with the public markets, as you say, sometimes the pendulum swinging too far one direction or the other. You've got the Vision Fund CEO, of course, the $100 billion that they've been putting to work, saying that private markets are overvalued. You've had the Cathie Woods of this world saying she's never seen such a disconnect between private markets and public markets than there are at the moment. Is the private market getting the memo from the public market, and are we starting to see valuations come down there too, do you think?
Yeah, well, again, much different, private versus public markets, right? Public markets they're mark to market, every minute of every, trading day. So you see that impact, and you see the volatility, right? With private markets, the only time valuations change, for the most part, is when a new round of financing is raised, and that price is set when that money is raised. Don't have the day-to-day volatility. Last year was a record year for fundraising. It was a record year for money going into venture-backed companies, almost double what it was the prior year. And so our valuation's healthy, very high, priced to perfection, absolutely. But there's so many incredible companies in that portfolio. So do I see 2022 and see some valuations corrections with some of these companies? The answer is I do. But that's a healthy market. It's a healthy market in the public, to be honest, and it's a healthy market in the private. So that being said, what I've said for years is that you look out and you say, what I can promise is that the innovation economy is going to be up and to the right. It just may be a little bit of a zigzag on the way up. So we're still thinking not just this quarter, next quarter, not just the end of this year, next year, but really several years out. And that's why we continue to invest in this market across our entire platform.
Greg, of course, you are a commercial lender to a lot of these businesses. They've got the investment banking part. Will we see fewer companies wanting to go public if they've been so priced to perfection in the private markets? Will companies again start to stay private that bit longer, or will they do their fundraisings out of the public glare if you've got this sort of volatility upon us?
Yeah. So I'll answer that in two different ways. One is I'll talk about the market, then I'll talk about our business relative to public listing of tech stocks, capabilities that we brought on board. So last year was an incredible year. When you look at the number of SPACs and just new IPOs, it was a really prolific year. Do we expect the same thing in 22? The answer is no. We do think it's going to be softer. But there's still hundreds and hundreds of companies that are performing exceptionally well that, to be honest, should be and could be public companies. Whether they choose to go out this year, that's up to them. They're going to make that decision. They're not going to be forced to, because a lot of those companies are cash rich and they can continue just to perform as private companies. So they're going to wait and see to what the market looks like. But there will be companies that will go public. Now for us, we've had a healthcare business in investment banking, equity capital markets, done extremely well the last couple of years. We've built onto that healthcare services and now technology. And so we're starting from a really small base. So we feel good about the upside for technology investment banking in this year because we're just building that capability. So some IPOs, but most of it's going to be around M&A. Private M&A, sponsor buyouts, and those sort of things. So it's really, you have to understand kind of where things are coming from. But yeah, it's going to be a little bit softer than last year for sure.
Greg Becker, it's always great to catch up with you. Thank you, CEO of Silicon Valley Bank, talking us through what he sees for the year 2022. Meanwhile, coming up, it's not just tech stocks seeing pretty large corrections. So is crypto. Bitcoin now down to a 6-month low. Not quite in a bear market, but close. We're going to talk to the CEO of Bitfury. That's next. This is Bloomberg. Crypto taking a hit, not just, of course, the coins themselves, but crypto-related stocks too continuing to stink. Question on now many a mind is how low will they go? Our next guest might be able to bring an insight or two into that. I want to send it over to our colleague Shonali Basak with more.
Yeah, absolutely. We're going to listen to what happened just yesterday, which is a big hearing in Washington, lasted hours. And, you know, Brian Brooks, the CEO of Bitfury, was one of the people to testify. Brian, you know, not your first time in Washington. Obviously, you were one of the main banking regulators. But what was the tone like for you yesterday in a hearing like this compared to what you've seen in the most recent years?
Well, you know, Shonali, the tone was, frankly, so much more substantive and so much less political, even than I was expecting. And I watched this stuff pretty closely. You know, you might have gone into this, the hearing was focused on Bitcoin mining and energy usage, among other things. And you might have expected this to be a Democrat versus Republican issue, with the Democrats on the environmental side and the Republicans on the free market side. But actually, the tenor of the hearing was much more measured than that. I think both sides were accepting that Bitcoin in particular and crypto generally is here to stay, that adoption has been very widespread. And the issue is, how do we mitigate some of the worst effects while allowing this technology to grow and gain adoption? I think it was terrific.
Well, here, one of the points that you made was that the Bitcoins that are mined and used are more productive for the economy per usage than the banking system has been efficient for this. So I'm curious as to why that is what you're using to measure the energy consumption as a whole for an industry rather than the absolute usage of energy for Bitcoin itself.
Yeah, well, so Shonali, the way that I think about it is everything we do in the world consumes energy. Like right now, I'm talking to you on a MacBook computer, which, you know, had to be charged earlier today, and you're sitting in a TV studio with a bunch of lights. So everything uses energy. The question is, how much productivity do you get per unit of energy? And that's a knowable fact. So it turns out, for example, I'm sitting here at an airport right now. Turns out the global aviation industry every year consumes 11,000 terawatts of energy, and it only generates a few $100 billion of market cap for that 11,000 terawatts. Now, Bitcoin has generated $1 trillion of value for 188 terawatts of energy. Shows that it's a good way of creating and storing value that the market has decided is valuable. And so I would just say, when you're talking about energy in the world, what you want to figure out is, are we devoting every watt of energy to the most productive use? And Bitcoin is pretty darn productive as measured by market sentiment.
But productive for you, if you live in a community and there's a Bitcoin miner there and the energy does not really get used for their home or their small business, doesn't that pose a problem for the person in the community?
Well, Shonali, that is actually a great question, and I'm glad you gave me the chance to actually kind of rebut that suggestion, because a lot of people seem to have in their mind a zero-sum approach to energy and a lot of other things. And so, look, if in a given town there was only so much energy to go around and a Bitcoin miner showed up and took it, you'd probably be right. But it turns out that the business model of Bitcoin mining is to help utilities build more power production. And so at Bitfury, one of the main things we do is we joint venture with utilities and renewable providers who want to bring more power into a community. And the problem with the economics of those is that the baseload consumption may not be high enough in that town to justify the new capacity. So the right way to think about it is we're the ones who are bringing you the additional capacity you need for all of the other purposes in your life.
Brian, I want to pivot a little. I know that you put some of your own money towards cryptocurrency, and we've seen such a sell-off in Bitcoin and other cryptos of lately. What are you hearing among investors on what they plan to do with their holdings? Do you see more selling? Do you see people buying the dip? Are you buying the dip?
Yeah, well, I mean, first of all, not that I give investment advice to other people, but yeah, I'm buying the dip. These are historic lows. It's sort of amazing that you can buy Bitcoin below $40,000 today, and I did. Not advising other two, but I definitely did. But Sonali, I'm a random walk down Wall Street kind of a guy, so I don't believe in following short-term price movements. You know, the evidence is that people who check their account every day wind up poorer than people who don't check their account every day. So to me, the more important things to know about Bitcoin price is, for example, a headline in Money Magazine from 6 hours ago, which reports that the majority of millennials and Gen Z Americans are putting crypto into their retirement plan. Or, for example, Goldman Sachs' recent finding from a week ago that Bitcoin has now overtaken 20% of the store of value market, 20% from gold, right? So these long-term macro trends are much more telling than short-term price movements, which go up and down depending on people's risk appetite. Look, tech had a bad day in Washington yesterday, had a massive sell-off in New York as a result of that. And crypto is just part of that, but you shouldn't be doing this for the short term.
Brian, that's some great insight there. Thank you so much for joining us. That's Brian Brooks, the CEO of Bitfury. Thank you. Let me send it back to Caroline.
And kind of phenomenal day all in all when you're looking at some of the, in intraday moves, Sonali, in whether it be the crypto coins, whether you're looking at, it wasn't just Bitcoin, of course, front and center, but you look at, Solana and some of the other key protocols that are all sort of being thrown out to a certain one side. Has anyone been telling you when they might find a bottom?
Yeah, that's the big question, because on Wall Street, it's all about risk management here. And if you can't find the bottom, then you're unwilling to invest unless you are putting your own personal money in it. But with that said, we're finally finding a little more about what it means to have a correlation. There was a sense that it was uncorrelated to financial markets, and we're seeing that's not necessarily the case.
What is it, like 0.4 correlation between the NASDAQ and Bitcoin? Like this is not a diversified trade
and what
away
about
from
interest
tech.
rates, right?
Yeah, I mean, the whole thing is, unfortunately for now, the digital gold argument seems to have broken down.
Yeah, absolutely. We'll see where it goes into the next year.
We'll have plenty more on crypto. We'll have plenty more on astronomical MicroStrategy move as well on the back of the SEC rejecting its Bitcoin accounting. We'll be digging all into it with Lee Drogan, of course, a man who's pivoted into the world of crypto. This is Bloomberg. Welcome back to Bloomberg Technology. Let's get right back into these financial markets because it was a blistering day. Bloomberg's Ed Ludlow looks at now not just the space in terms of stocks, but cross-asset, the crypto space too.
Yeah, I think it's been a really interesting week, and a lot of the volatility, or the big moves, to be more precise, in Bitcoin that we saw came Friday in the last 24 hours. You see there on the left-hand side of the screen, we've fallen from 43,000 US dollars to 36,000 US dollars per token on Bitcoin. Not that quick, very quickly. So I guess the question is, what's the next level that we're watching? I guess 34,500 US dollars per token would represent a 50% decline from that November peak. But there's quite a close correlation, of course, with crypto-related stocks, the two highest profile of which on Friday were Coinbase and, to a certain extent, Robinhood. Coinbase, biggest drop on record since it listed last year, down more than 13%. Closing at the lowest level since it listed last year. And a similar story for Robinhood, dropping 5%. Of course, that also tied to the equity markets, closing at the lowest level since it listed last year. And we've seen these things move in lockstep. We have asked the question, of course, if Bitcoin, for example, is an inflation hedge. But what we know about these kind of exchanges is that volatility has been good for them when they've reported earnings. But I love to look at these two indexes. These might be new to you, Caroline. Let me know. The Bloomberg Grayscale Future of Finance Index is 22 companies across the world of disruptive technologies, blockchain, crypto-related currency companies. And it's a really interesting gauge because when you put it alongside the Bloomberg Galaxy Crypto Index, which of course is largely Bitcoin and Ethereum, but some other of the larger market value tokens as well, you can see that kind of symmetry in the way they've moved year to date. We've lost about $1 trillion of value across crypto since that November peak, much of it coming in Bitcoin. Where do we go from here? It's a time to take a pause, take a breath. It's been a very long week.
It has been, Ed. Take a breath, maybe something stronger as well. We thank you. Meanwhile, we want to stick on the crypto implications, the slump that we're seeing. Is it time to buy the dip? Lee Drogan's with us. He's the general partner and chief information officer at Starkiller Capital, cryptocurrency hedge fund, one of the key thought leaders in this space, Lee, therefore. And I'm really interested in what you're seeing in terms of why people aren't buying at the moment, why there is no catalyst to decide that, the debate has always been out as to whether this is an inflation hedge, whether it's digital gold, whether it's just a risk asset that appears to be trading like at the moment. Where do you stand as to what point the price gets so low that retail institutional comes into play?
Yeah, don't be mistaken by the kind of libertarian gold bug, Bitcoin holders. This is not an inflation hedge. This is a risk asset up and down. It's even more of a risk asset now that most of the crypto market cap is Ethereum, Solana, and all sorts of other stuff that is basically just technology where we're pulling forward massive assumptions of global growth into the present. And this is why, the market caps for all of these coins vacillate within a massive range. And that's why at Starkiller, we run a momentum-oriented strategy because it's just momentum all the time. Now, one of the really important aspects of that strategy and what we look for to call tops and bottoms is basically the volume profile. This market is largely retail driven still. The inflow of that retail capital is a persistent TWAP bid on the market. They're throwing market orders at the thing every day. When that volume disappears, these things are basically illiquid. And without those bids, you're seeing what happens right now. And that volume has been gone for a while now, which is why we've basically been in cash for a number of weeks and hedged, even before that. At some point, yes, the drawdowns will get so significant that we'll want to bid again. 31,000 is kind of a number that, we're looking at. I'd be surprised if we don't get there at some point. It may not be in a straight line, but I'd be surprised if we don't get there. And at that point, you should see some support come into the market. Is it totally possible that we have another 80 or 90% drawdown in the asset class? Yes, that is 100% possible here.
Why has the retail bid evaporated of late?
It's a great question. I think that's more tied up in the macro-oriented environment. I think, yes, rates are, one piece of it. I think there's also just people went back to work and they stopped sitting at home trading. There are a lot of different pieces to that are more macro-oriented than cryptocurrency specific.
What about your own view on where in the asset class you get into? Because you can play the space in many ways. Perhaps there are not as many ETFs as people would like in the United States, but there's certainly, the blockchains, the MicroStrategies, the ways in which you can take a stock market view on crypto, or indeed there are the coins themselves, and not just Bitcoin, but going through the whole range of DeFi and the like. Where are the opportunities from an asset class perspective?
So the way that we look at equities that are kind of crypto tied, or most of them are associated with what we kind of term the casino. Mm-hmm. And during a raging crypto bull market where all of this retail flow is coming in, you absolutely want to own the casino. You want to own Coinbase. You want to own Robinhood. You want to own a bunch of those other names that are facilitators and picks and shovels. Right now, when that volume is gone, absolutely not. And that goes for the cryptocurrencies themselves, too. All of the lending protocols, all of the decentralized exchanges, you don't want to be anywhere near those things because there's just no volume right now.
And to your perspective, what point do we stop being so beholden on retail investors for the volume? Because I thought again and again, 2020, 2021 was about the institutional player coming in. Where are they?
The institutions are here. We have a pretty big firm, and there are more coming. You've seen all the capital that Andreessen and other venture firms have raised. Here's the issue, and why I don't think we're going to see a slowdown in the volatility, anytime soon, In equities, there's basically a buyer of last resort at some reasonable multiple, because market participants, in history have basically agreed that Apple's not going to trade at 5 times earnings. That would be crazy. And if it does, it's going to trade there for a day and then it's going to bounce hard, because there's a buyer of last resort at that multiple. In crypto, because the assumptions that we're pulling forward from future growth are so extreme, there is no buyer of last resort. Things can go down 90 or 95%, and that would be completely rational, just as rational as them going up 100 times over the course of a 6-month period. Both of those things are completely rational, and that's just the market that we're going to have to deal with.
Lee Drogan, we thank you for taking a moment out of what is probably a pretty busy day, and unfortunately, for anyone doing crypto, a busy weekend too. General partner and CIO at Starkiller Capital. We thank you. Meanwhile, in a rejection for MicroStrategy, now the US Securities and Exchange Commission, the SEC, says the firm can't strip out Bitcoin's wild swings from the unofficial accounting measures it touts to investors. Now, the enterprise software maker, remember that's actually what it is, said back in 2020 that it was buying and holding Bitcoin, and it was one of its key business strategies. But it used non-GAAP measures to show that its income would have been if it didn't have to impair the volatile cryptocurrency, which the SEC has objected to. Now, coming up, the power of the marketing in the digital era. What works, what doesn't, how the best brands empower instead of disrupting, and, well, maybe some lessons learned from Peloton. This is Bloomberg.
Apple fans will likely have to wait a little bit longer than expected to get their hands on Apple's first mixed reality headset to compete with Meta's Oculus. The iPhone maker had planned to reveal the new device as early as this June at WWDC and then release it later this year. But the company has been facing some development challenges related to the device overheating, camera technology, and a new operating system. That means that an intro as early as the end of this year or early next year with a wider consumer release in 2023 is more likely. The headset is planned to have super fast M1 Pro-like chips, immersive audio and speaker technology, and capabilities for media consumption, gaming, and communication. The headset will be pricey, however, and probably cost well north of $1,500. The product will be Apple's first big new bet since the Apple Watch launched 7 years ago, and it should enable an all-new class of applications and a developer ecosystem through an onboard app store. Apple then plans to use WWDC 2023 to engage VR and app developers to write software. The first headset, however, is only the beginning for Apple's ambitions in the space. The company is planning a standalone augmented reality headset as a follow-up later this decade. I'm Mark Gurman. This is Power On.
Don't forget, you can subscribe to Mark's weekly Power On newsletter at Bloomberg.com. Let's talk about Peloton. It's been trying to push through the pain of slowing sales. The stock rebounding slightly after CEO John Foley vowed to slash costs, which he said could include, unfortunately, job cuts as the company looks to, quote, reset production levels for sustainable growth. Peloton, of course, reeling from a slowdown triggered by customers returning to basically a more normal life, perhaps, including traditional gyms. Foley also addressed reports that the company had temporarily shut down production, saying the info is incomplete, out of context, and not reflective of Peloton's strategy. I want to stay on the topic of Peloton because my next guest has a few thoughts as to why the company has struggled so much of late from a marketing perspective. Joining me now, Jeff Rosenblum. He is the founding partner of Questus, a digital advertising agency. He's also the author of a new book, Exponential: Transform Your Brand by Empowering Instead of Interrupting. Jeff, welcome to Bloomberg Technology. And I mean, before we get onto the individual expertise of the book and what the story you're telling, what's the recipe for Peloton? What's gone so horribly wrong in terms of the way they talk to the consumer?
Yeah, I think the Peloton story can be broken up into sort of a tale of two cities, the rise and the fall. And they're both really highly interrelated. So during the rise, what they did is they empowered their audience, right? It wasn't new technology. It wasn't new communication. What they were able to do is say, let's connect these stationary bikes to streaming media and empower people. Let's give them the right content at the right place at the right time and improve their lives. With that, they were able to get sort of the low-hanging fruit. But I think the big question now is what's going on? And the issue is they're not playing offense with their brand. Think about what happened just a few weeks ago. when there was the Sex and the City reboot, and all of a sudden the stock price went down 4% in one day because somebody died on this show because they were using the Peloton bike. Well, a company with a $10 billion market cap, they shouldn't have that kind of impact from a fictitious scene on a show that very few people are aware of and very few people have actually seen. So what I think they really need to get back to is playing offense with their messaging, communicating to people what makes their product different, what makes their product better. Because it's clearly a great product, but once you get past the low-hanging fruit, it gets a little bit harder.
Yeah, because I think for many, who use it avidly, they didn't care. They still knew they loved their product, but it's about the messaging to the new user. And talk to us, therefore, about the ways in which, who would you say has had the perfect strategy over the years, as you, as CEO of Questus, has really analyzed which businesses get it so right?
Well, I think the poster child for the company that really does it right is Patagonia. And I always look at the world through the advertising lens. And what they do is they don't use traditional interruptive advertising. They create immersive content. They empower people, they educate people to let them understand how they can defend the environment better. But I think as effective as Patagonia is, a lot of people sort of misanalyze it. They think it's a green story. And brands need to realize people don't wake up in the morning expecting every brand to hug the trees and save the manatees. It's about empowering people. It's about improving people's lives one small step at a time in an authentic way.
But what was interesting about Patagonia is perhaps it got hijacked to its own degree by tech bros, by banking bros. I remember all the ones where Patagonia was sort of stopping people buying, companies ordering their clothing. Was that the right tactic to reclaim their messaging, not let it be taken away from them in some way?
It's a very bold maneuver, and I think that's why Patagonia succeeds. They're bold over and over and over again. I mean, at one point, they took over their entire website with a message that said, "Don't buy this jacket." And they literally talked people out of buying more products from them because they wanted to educate people about manufacturing byproducts and garbage from consumerism. So boldness is the way to go, and I think that's what's missing with Peloton. Returning to that example, is they're just not bold with their external advertising. They're relying on 30-second spots, and that's just not enough.
Jeff, what about the means of communication and also the ramifications there? We're seeing at the moment, the ups and the downs of the likes of TikTok. We just think of some of the, I don't even want to pay lip service to it, but sort of how vitriolic and sort of in some ways negative TikTok can become against one particular human being, for example, as we've seen. How are you seeing companies embracing the right format for their messaging?
Yeah, that's a really fun question. And I think the automotive industry really opens our eyes to it because there's published research. The typical person spends 13 hours on their journey. Once they decide they want to buy a new car, 13 hours before they complete the purchase. So most brands are really focused in on, a few seconds in the beginning of the journey through TV, or through your example, like let's try to hit people with a bunch of TikTok messages. The real answer is how do we find what people really are looking for? And it doesn't need to be superficial messages, and we don't need to use interruptions on TV or TikTok or whatever new platform is out there. Let's understand the journey and exactly what people are looking for so we can bring meaning and value to that communication flow. Really
fascinating expertise at the right time when we need it. Jeff Rosenblum, CEO of Questus, but of course, author of his new book. Go and have a look. Exponential. That's the lessons learned as to how to transform your brand with empowerment. Meanwhile, coming up, how to make sure women-founded startups get the funding they need. We're going to talk empowerment there as well with Astia CEO Sharon Fosmek to talk about the latest report on what needed to happen to level the playing field. An exclusive interview for Bloomberg Technology. That's next. So the age-old question, how do female founders get a larger piece of the investment pie after a recent PitchBook report showing that women founders secured still only 2% of venture capital in the US in 2021. Now it's the smallest share since 2016. Conversation is more relevant than ever. So let's bring in Astia into this conversation for their insight. Dedicated to leveling the investment playing field and just releasing, well, some really interesting findings from a 3-year pilot program launched to make sure their investment flows are more diverse. Astia CEO and Managing Director Sharon Vosmek joins us now. And fascinating, it's almost a mea culpa moment for you. And that's what's so enticing about this story, because you launched this pilot program in reaction to the fact that you realized there was racial bias baked into some of your investment decision making.
Absolutely. And Caroline, thank you again for having me on for this conversation. You're absolutely right. It's a mea culpa moment. The reading is well worth doing if you're an investor out there. It was completely humbling to be an organization that for 20 years thought it had removed bias from its investment process, to only learn that actually when you intersect gender and race, we had just as much of a problem as other organizations.
And to that point, you then sort of look at trying to fix that. From the immediate, like, I can't believe this has occurred, what do you then put in place to be like this? Was it assertive action? What was it that you needed to do?
It actually was. And by the way, your inhale is exactly what my inhale was. It was a very public moment when we discovered it. As you rightly point out, it was a dinner party hosted for the companies that we did not invest in, but we thought were best in class. And 80% of those CEOs were Black. Then feeling kind of smug in that moment of inclusion at that fantastic dinner, reflected on our portfolio, which had 0 Black CEOs within it. But here were the companies we had passed on, but were exceptional. We are hosting the dinner to catch an update on them in case we should invest now. You're right, we dove right in. Day 2, I called day 1 the dinner. Day 2 was a really hard moment for us organizationally. We called the whole team together, had a very frank conversation about the finding at the dinner. And then we did the hard work of looking at our personal data. You mentioned that in the market, something's happening that's not allowing venture to flow. Fine, that's all interesting and well and good. But what we did was dove into our own data and made, in this report, our actions and our findings very public, because we believe it's part of the solution.
Okay, so 3 years since the pilot launched, you're doing the learnings. Your portfolio is now how much people of color?
The Astia Fund is 50% Black female CEOs. Fair enough that we only have 4 companies right now, but it's through the hard work we did that we were even able to deploy that. The direct investment program called Astia Angels, 25% of their investments post the learnings are into Black female CEOs. Fundamentally what we had to do was acknowledge that while our sourcing and screening and assessments of the businesses were hugely inclusive, and we had removed bias in that, where we had not removed bias, where we had failed to appreciate, was truly at that final moment of investment decision making. In private equity, or specifically in venture capital, relies a huge deal on that personal conversation and the gut check. And that's where we found that our gut check had bias built into it. And we had to find very thoughtful and process-driven ways to remove the gut check from our investment decision making. Sounds counterintuitive, but it's actually the hard work that we had to do. We're better investors for it. Our performance not only continues to be exceptional, it's hugely inclusive of women of color. Really important work.
What was it at the gut check moment that was stopping you? Was it the fact that, was it because you weren't from similar backgrounds, that you couldn't understand, you weren't getting the understanding that you wanted, and therefore how are you ensuring that you're going geographically where you need to go, how you're ensuring that the pipeline is where you need it to be?
The unfortunate thing about bias is that it's hidden in all sorts of what I call the softer sciences. And it's not as easy as it was exactly this. But I'll give you examples of some of the differences. One was the questions asked at the point of investment. When we measured the questions asked, the Black women were asked what they had achieved with the capital they've raised so far. Our white women tended to be asked about the potential of their business, where they were taking it, the opportunity for investing. So you can see how just that subtle distinction, very subtle, right? Nuanced. So what we had to change was we are rigorous about the questions we ask. We do not deviate from the questions based upon the entrepreneur, but instead we have rigor, I call it investment rigor, in everything, including the final decision at the point of investment.
Really fascinating. Thank you so much, Sharon, for spending some time. We've all got to gut check ourselves and think deeper, work harder. Sharon Vosmek, Astia CEO and Managing Director. We thank you. Have a wonderful weekend. Stay well all. In fact, that does it for the edition of Bloomberg Technology, but some breaking news for you, because as we go to break, as we go to this weekend, crypto taking another leg lower. Check out what's happening in terms of the price of Bitcoin. We haven't seen these levels since July. 36,000 is where we've currently broken through. Look to those technical levels. Wall Street Week is up next with my colleague David Weston. This is Bloomberg.